That's for me.
Location fits into it. So the long and the short of it is.
Absolutely. How about at the end of the day? Do you do anything? Like, I'm really fascinated by rituals.
So I think it's really important to be ethical and make sure you're paying them well above.
Innovators is that when you look at a property perspective, it's your home.
Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Alrighty, it seems we are live after a few graphics, a few intro sequences. If you can hear me, say g'day. I can see a few people in the chat already, which is amazing. So thank you everyone for joining us. First ever Rask Live. I feel like I should have more of a crisp intro, but I don't. So Monique helped me out with the graphics there. And if you're joining us from the Rask YouTube channel, g'day, good evening. If you're joining us from Selfwealth, hello and welcome back. And if you're joining us from the ASA community, welcome to you tonight as well. Now, this is a bit of a housekeeping note. We do stream now to multiple destinations. You could be watching this on LinkedIn, Facebook, wherever you get your information. Definitely the place to be is YouTube, whether you're on the ASA, Selfwealth, or Rask channels. Don't forget to hit subscribe. It's the best way to get notified every week when the Rask Live show takes off. Okay, happy hump day, says Martin. G'day, Martin. Welcome back. Okay, so we have a lot going on. Lee, good to see you in the chat. Giveaways tonight. Not so many giveaways tonight, Paul. There will be a few giveaways in a few weeks. Maybe I can show you what those are or give you a hint of what might be happening in a few weeks. But thank you so much to everyone who's joined us for the first live show. This is a bit of an interesting show because tonight we're going to talk about reasons why you should be investing right now. And I know that might seem a bit shallow or a bit glib, a bit whatever. But at the end of the day, there is so much going on in our world that it can be hard to make heads or tails and know whether right now is a good time to invest. And because this is effectively the start of an era with Rask Live as opposed to Selfwealth Live, which has been running for a couple of years now, or it's more of a continuation, I wanted to cement some really important lessons as we go forth over the next couple of years in this new format. And for those of you that have been around the Trap Selfwealth community, we love you all. Rob's behind the keyboard tonight as always. You may have seen a couple of these things, so feel free to jump in, share your views, and as always, just ask a question and share your perspective. So good evening, everyone. I'm going to start with the first slide that I've got. Now, I was putting these together today, and hopefully you can see that. So welcome to Rask Live. We go live every Wednesday. If you are new here, we go live every Wednesday for 60 minutes. And it's not always just going to be me. I'm about to get to some of the guests that we've already got lined up for the show going forward. If you haven't already subscribed, wherever you are getting this, please subscribe. It does go a long way in helping us. And what it actually does for you, if you subscribe to the channel, and let's say, for example, you have YouTube on your app, on your phone, it will send you a notification when we go live and it will say, would you like to view or watch live now? So that's one of the benefits of having it there. There's really no other benefit to us other than knowing that people want and like what we're doing. So hit subscribe there when you get a moment. So coming up this month on Rask Live, here are a few of the segments we will be featuring in the coming weeks. We've got 10 reasons to invest tonight. Next week, we've got the top 5 ETFs in Australia. Our most popular analysis of all time was which share ETFs are the best in the country. So we'll be revealing that next week. Me and the analyst team Following that, we've got Scott Phillips from the Motley Fool. He's coming on to give us 5 foolish stocks, 5 stocks straight from the Chief Investment Officer of the Motley Fool Australia. Chances are you know Scott. He's been on Selfwealth Live. You probably know him. Then we'll dive into a macro update early next month. Important point, this one right here and this one right here. So not tonight's obviously, but the next 2 weeks, they're going to be recorded during the middle of the day. So they'll be live, but they'll be at midday. And that's Australian Eastern Time. And I do apologize for the inconvenience, but there is a very good reason, which I'll get to in just a moment. If you haven't already familiarized yourself with some of these faces down the bottom here, you will see them in coming weeks. We've got some fantastic investors, some CEOs already accepted an invite to the show. So some really big CEOs as well, like some of the best in the country. So I'm really excited to bring them onto the program, and you can ask them questions directly. Now, I noticed there was a question from Matthew about Rask underwear. There is no Rask underwear currently available, but we do have beanies and we do have caps. There's plenty of these to go around. The beanies do not fit my big head, obviously. So there's about 500 of them I've got to give away before summer hits. Talk about market timing. Probably not the best move by me, but that's okay. Anyway, so you'll receive an email for next week. Just a reminder, these are on Wednesday, midday, and then we'll go back to regular programming. And the reason why is because we've got the Rask Roadshows underway, events right around the country. We're wrapping up with 4 events remaining out of the 10. We have Port Macquarie, Wangaratta in Victoria. We have the big event in Sydney. And of course, we've got the event in Newcastle. So many great guests proudly brought to you by Rask, Global X, and Waddle Partners. So I'm super excited. There's some footage of the Adelaide event. Duke here on the left won too many prizes, to Paul's point. I think Duke went home with probably about $700 worth of prizes because he put his hand up for every game that we did on the night, and he seemed to win them all. So he even got an Apple Watch and all of that. So good on him. So Chris over on LinkedIn, Rask cap. Oh yes, Rob, you did get a Rask cap the other day. Rob from Selfwealth. I did give you one the other day. So if you see a bloke about 6'6" walking around Melbourne CBD with a Rask cap, that's not me. I'm not that tall. So that's Rob. Say good day to him. Anyway, so I can see there was a comment here from Rhea about Kate's new book. That's Kate Campbell, my co-host. Buying Happiness by Kate Campbell is out now. You can get it on Amazon. You can get it on Booktopia. You can get it wherever you get your books. It's a fantastic book, and it is currently on sale. Look at that, 18% off for all value investors here. So grab yourself a copy. Support Kate. You probably know her from the podcast anyway. She will be on the show in about a month's time. So she'll be coming here live to answer your questions. You can talk to her about using money to buy happiness and all of these types of things in around about a month. So stay tuned for that. Anyway, on to tonight's segment. Hopefully we can wrap this up in around about half an hour, and then you can just fire away with your questions. Some of you will know, thanks Rob for dropping it in the chat there. There's a link on Booktopia, just Buying Happiness, the book. That's the one that you want right there. So 10 reasons to invest right now. Now, obviously this is quite a catchy title, but it actually is a genuine statement. And let's zoom in a bit here. Because a lot of the time when you speak to your friends or you speak to your peers or you speak to your colleagues or whoever you're speaking with about investing, almost every time they don't say now is a good time to invest. Almost every time they'll say something like, I heard the market is about to crash. And this is what we call the behavior gap. And it happens so often in investing. Even people who are index fund investors who believe they have the holy grail of investing, they believe that they don't need to worry about this stuff. But it's actually so true, because what we find with index fund investors in particular is they tend to do worse than the index fund itself, because they tend to let emotions get in the way. So tonight is all about giving you some rules to live by, some reasons why you can invest right now or stay invested, and you can do so confidently. So Connor, you've said you can use money to buy a motorbike, which is dang close to buying happiness as you can get. You know what, Connor? It's actually really interesting. It's really interesting because there are ways that you can use money to your advantage, and Kate talks about all of those in the book. Paul, you've just given me a new idea, and I'm going to write this down. Dave Gow from Strong Money. I'm just going to pop him down under the live guests. So anyone that has a guest who wants to speak with someone in Australia, an author, a CEO, an investor, please pop them in the chat and I will add them to my list. And you'll be pleased to know we've got about 100% strike rate so far. So hopefully, we haven't tried for Warren Buffett though, just as full disclosure. I didn't try that. I think that might have been Martin or Paul last week who said we should try and get Warren Buffett on the show. Haven't been able to reach out to him yet, but I will try. Anyway, back to the reasons to invest. So a lot of people end up walking away from the stock market at the worst possible time. Now, some people might have said, and we, in fact, on the live show, said that we were probably at this point about 6 months ago. And subsequently, the stock market, and in particular, the US stock market, has rallied 20, 30% in 6 months, which is just incredible. And yet that's when people were selling. So it's really important to check ourselves on these types of things. Now, one final thing before I get to my list. When I jumped into Google before, I typed in stock market crash and there were 503 million results in 0.49 seconds. So 503 million results. I'm giving my list of 10 up against the 503 million. So these are some of the recent headlines, and this is no slight to any of those publishers or authors or journalists, but these are some of the headlines that ranked really highly in Google. Stock market crash. Expert says far deeper market losses will emerge. That was 2 days ago. The Big Short is preparing for a stock market crash. Here are the odds that the stock market will crash. That's from MarketWatch. So all reputable outfits that say these things and publish these headlines. Now, we all know why they do it. Many of you will know that I myself started a financial news website. In fact, started a couple of them. And what I noticed early on when I was building these websites and writing news and analysis on ASX shares is that on a negative day for the ASX 200, we would get around about 50% more traffic than if we had the same. We had that. So say the index, the stock market goes up 0.5%. If that went down 0.5%, we'd get about 50% more traffic to the news articles. Now, that's not science, perfect science, but it gives you a sense of like how people are attracted to fear. So there's no wonder why the headline writers do this. We're all just, I guess, engrossed in the fear of it. So I just want to make that apparent. Like, we know why they do it, but sometimes we're not always attuned to why it can impact us and how it can impact us. So these 10 rules I first laid out as part of the Rask investment philosophy quite a few years ago. So if these rules look familiar to you, if you've been following me or the company or then any of our experts for quite a while, you'll know that we all follow these similar rules. And these rules from 1 through to 10 are designed to guide you when everything seems uncertain. And so this chart here is, let's just start from the top. So number 1, capitalism works. I don't know about you all, but if I go to a finance event and the first thing that someone does is doubt capitalism, I'm automatically on the back foot. Not because I'm like a, dyed-in-the-wool believer, but all of the proof seems to suggest that capitalism works. Because if we are investors and we work hard and we earn money, we should then be able to use that money to invest in things that solve more problems for people. And the best example of this that I gave in the email, which I sent out earlier this week, was if you're investing, if you're going down to the train station in the morning and you like to get a cup of coffee on the way there, you pay $6. It doesn't cost $6 to make that, but that's the price it costs for someone to solve your problem, which is the caffeine hit. Now, you could have made that at home, but at the end of the day, someone has taken a risk to start that business and try and prove to you that it's worth the $6. And so that's capitalism at work. So when someone instantly says it doesn't work, I'm always a bit dubious of why that is the case. And this chart here actually plots the annual gross domestic product of Russia and the United States. Now I'll get this little guy out of the way. But what it basically shows is the productivity of a capitalistic country, which is the United States, against Russia, which during the Cold War was one of the probably least capitalistic, at least so they thought, countries. And you can see the kind of dichotomy, the shift between the two. So this system is basically the basis of why I keep investing. For as long as we will let people and businesses solve the world's problems, I'll keep investing because I think it's the only thing that's been proven to work, and I think it will keep working. Log charts, yeah. True, true, true. Notice it's like that's a good one. Wollong Gabba could have used a log chart here. Actually, this chart came from a website which probably could have done a better job of tracking GDP back before 1990, but we know why that is there. Okay, so number two, the stock market is a weighing machine. Now, in the short term, Benjamin Graham originally said that in the short term, the stock market seems like a voting machine. So if we crack out the ASX 200, like this right here, and we go for the last 6 months, it just looks like it's completely random. It looks like there's a bit of shark's teeth in there. Someone could maybe draw some sort of fancy chart over the top, and who knows what would come up. But the longer we go out into the future, the smoother the results become and the better the chart looks. Now, this is without dividends. If we go, I think it's XTN, I could be wrong here. No, that's not it. ASX 200 total return. Now, let's get this one up. Now, let's go to a 20-year chart. This chart includes dividends, and now we can see the total returns from the Australian stock market. So here we can see dividends, and it does not look random. It does not look random. So the further we look out into the future, the less random the stock market becomes. And so that's why we say that it's a weighing machine, because the longer that you are invested, the more likely it is that good companies will do their work and the bad companies will fall away, those speculative things that just go up and down randomly. And so here we can see this is a chart from Boston Consulting Group. I don't think I've shared it here before. Maybe I have. And what it does is it shows the top 25 companies in the world over the past 25 years for creating value for shareholders. So this would be like the companies that have expanded the most in their market capitalization and created the most wealth for people. And you can see here that companies like Apple and Monster Beverage, Amazon, so on and so forth are in the top at the top of this list. Now, what's quite interesting here is, other than that, you'll know basically all of these names on here, or at least most of them. What's really interesting about this is that this company that's second on the list here, which is Apple, that has a market cap at the time of recording over $2 trillion and has risen at 33% a year for 25 years, including dividends. What's incredible about this business is the share price, as Lachlan Bird Jensen told me today, the share price has fallen more than 70% 3 times. So in order to get these returns, you would have to sit through a 70% sell-off 3 times. And I can almost bet that everyone here would be doubting themselves and what they've done if they just saw that in front of them. But at the end of the day, all of these companies on here are fantastic businesses. They would never make this list over 25 years if they weren't fantastic businesses. They're not just random stock charts going up and down, they're businesses. And that's why in the short term, the stock market can seem random because it's based on emotion. But over the long term, it's the business that wins, and the business drags the stock price higher. When we think about wealth creation at Rask, we think of basically this very simple balance sheet. You have all of your assets, and then you have your liabilities, and then you have what's left over. This is exactly the same as a company's balance sheet. In a company's balance sheet, you'd have assets, short-term assets, long-term assets. You'd have liabilities, short-term liabilities, long-term liabilities, and you'd have equity. This is exactly what we think about at Rask. But if you think long and hard about what you're doing with your investment portfolio, this is really all you need to remember. People really overcomplicate their investing because they're trying to use debt to grow this faster, and for a whole bunch of other reasons that are basically behavioral, which I'll touch on in a minute. But at the end of the day, what we're trying to do is build a portfolio or build our personal balance sheet as big and as quickly as we can, so then it can create a flywheel of cash that just gets bigger and bigger and bigger. But so much of Australia, and all the data seems to suggest this, so much of Australia is actually in a huge amount of debt. And one of the things that doesn't get enough attention, in my opinion, is this last thing down the bottom here. An investor that I had on the Australian Investors podcast really early on once said to me that he believes depreciation is the single biggest killer of the middle class. And when he said killer, he meant finances. Depreciation is the falling values of items. And many of you will know what I'm talking about here. One of the big ones is your car. A car for the middle class can cost $10,000 or $20,000 a year just in depreciation, just in the value of that car falling. And I dare say that's what we're going to see over the next 2 years, is the price of cars will probably fall. So I think being aware of this chart is actually it's really refreshing, because all we've got to do is just pile into this side of our balance sheet right here and go from there. Benny, you've said, good request. I'll just interrupt this recording. You've said, could you get Andrew Brown from East 72 on? He seems good for an interview. I've spoken to Andrew Brown a few times. Andrew Brown, East 72. If you haven't already checked out Andrew Brown on Twitter, go and check him out. Okay, so here we go. Next one. So that's the third reason. Number 4, fewer decisions are better decisions, typically. Not always. And I've got the Eddie Murphy joke here. That's a skit. I think it was from Delirious. Maybe it was from Raw. I don't know. But one of his stand-up shows where he said, if you're starving and somebody throw you a cracker, you're going to be like, God damn, that's the best cracker I ever ate in my life. And the idea is that when you're investing, a lot of people choose their investments pretty willy-nilly. They just kind of pick and choose, and whatever happens, happens. There are so many sayings around the importance of taking your time and making good decisions. But what we've seen over the last 10 years from the investments industry is we've seen the most successful investors have favored automated types of investing and repetition. So dollar cost averaging would be a good example of that, where you don't have to make heaps of decisions. You just make the same ones over and over and over again. And it makes your life a lot better. I do have the book from Equity Mates, if people know Equity Mates. It's got, the title is Don't Stress, Just Invest. And that's what we're seeing from this new wave of investors. Unless, which I'll get to in a minute, you have all of the ingredients that make you a great stock picker, you're better off just sticking with a few investments and just doing the same thing over and over again. This is called, building a habit. And so many people know this, but so few people do it. A really good one of these is a habit that's automated, is actually just signing up for a dividend reinvestment plan. If you're in the United States watching this, you might call that a DRIP. A DRIP, as it's commonly known in the United States, which is just a dividend reinvestment plan. You just get all of your dividends and they're automatically reinvested. I would like to know here, just if anyone in the chat uses a dividend reinvestment plan, either on ETFs or on shares. If you use a dividend reinvestment plan, I'd love to know what's been the most successful use of that. So which company have you used it for, or which ETF? I myself don't have a dividend reinvestment plan set on. I just take the dividends and then invest myself. Owen, you've said, I love my DRP. My accountant is not a fan of it. So most people, I would say, that I come across don't use DRPs for the majority of their portfolio. They just take the cash and then reinvest it, which is perfectly fine. Okay, so fewer decisions equals better decisions. There's one final thing I want to add on this. When I did a study, or when I was part of a study that showed that fund managers who have less than 30 stocks in their portfolio, active fund managers who have less than 30 stocks in their portfolio, as a whole, tend to do better than fund managers who have more than 30 stocks in their portfolio. And I think that comes back to because they've got more on the line. If they've only got 30 stocks and one of them goes wrong, that's, they have to justify why that's gone wrong. But if you've got 100, then it's not going to really have an impact. None of your investors are going to notice. So my point is, when you are making decisions, treat the decisions as if you might only have 10 or 20 of them, as Warren Buffett would say. Matthew, you've said you use all dividend reinvestment plans for all of your investments and you get a 2% discount. These are great. So there's good answers in here. No one's really using them. Agus, you've said use it for Wes farmers. Kona, you've said for Vanguard. Robin, you have DRP set up for AFI and VAS. It's really interesting, Robin, that you would use that for AFI because if I'm not mistaken, AFI is a DSSP. So it's a slightly different one, meaning that it's a really interesting tax pay structure. For anyone that hasn't covered it before, you should look up something called DSSP, a dividend substitution share plan. You should look this up if you're a high tax payer. Go and look this up after this live show. It might be worth it. You can thank me later or thank Robin because she might have mentioned it without knowing. Go and check it out. Okay, so back to the list. Let's go down to diversification. So on one hand, I'm saying fewer decisions are better, but it's important to get diversification because as this chart shows here, and I might get out my Mr. Squiggle, as this chart shows here, you always have a certain level of risk when you invest. So people are like, yeah, but my portfolio is still down 20%, right? It's still down 20%. And I would be like, yes, that's just the stock market as a whole, for example, last year going down quite a bit. But what you don't get when you're diversified, when you have, say, some shares, some bonds, some Aussie shares, some global shares, is you tend to neutralize all of this bit. And I won't bore you with the academics of it, but basically what it means is when you are making individual stock tips or stock bets, or you're buying just thematic ETFs at random, what you could be doing is you could be exposing your portfolio to what we call individual company or security risk. Sometimes this is called specific risk. And so the way to think about this would be like, imagine you put all of your money into one investment property. And it just so happens that that street is in a bushfire. You're basically putting all of your portfolio in one investment. So you're getting the maximum amount of risk, right? But let's say instead of having it in one property, you have it in, say, 20 different shares. Let's use shares as an example. You're going to diversify away the risk that something happens to most of those shares. So let's say there's a bushfire. Well, maybe your shares aren't affected by that anyway. But let's say, for example, that the banking sector falls. Well, chances are only part of your portfolio will be impacted by that. So you're actually getting the benefit of this whole area. Now, with the benefit of ETFs, you can actually diversify not just in the stock market, but you can invest across different markets like bonds. You can go to different parts of the world. You can go to cash. You can do all of that. So that's why ETFs have proliferated and why they're such a great tool. But you can still get it wrong, and I'll explain why in just a minute. But at the end of the day, as long as you have your money in investments, you are going to experience something called market risk. This is still the thing, like where it goes up and down a little bit over a year, but you're not going to get the wild swings like you would, like a 50% fall completely, for example. Most people, when they think of diversification, they think, well, I just, go and buy the big banks and I'll buy these ETFs, and not realizing they kind of all do the same thing. And underneath it all, there's this one big risk that they're all exposed to. And so in this case, it might be house prices. So you might be diversified by the number of investments that you have, but not by the actual exposure of what you're getting. So when you do build a diversified portfolio, and I can tell you exactly how to do that, just be mindful that they're not all focused on the same thing. And a good example of this would be investors who, for example, they'll go and buy the IVV ETF, the S&P 500. They'll buy the NDQ ETF from BetaShares, and then they'll go and buy the Qual ETF. And just for extra diversification / not really, they'll go and buy VGS from Vanguard. And then what they'll realize that all of them have a huge overlap. So even though there might be 4 different ETFs, there's a massive overlap between them. And so you still end up with a portfolio that's heavily concentrated to just a few shares. So that is something that I would just air with you tonight for those of you that haven't done it. Robin, you've said AFI is both a D, SSP, and DRP. Thanks, Robin. I really do appreciate you clearing that up for us. Okay, here we go. So if you bury risk with massive portfolios, why not just index fund? Just get index funds. Yeah. So Woolum Gabba, that's a great question. You're referring to this here, like what if you're going to buy so many shares or ETFs or whatever? Why not just use index funds? And yeah, you could, right? You could. But I'll come to this as a really interesting point. And if I haven't answered your question by the end of tonight, Woolum Gabba, come back to me, okay? So there's a good question here. William, you said, is there an oil / energy ETF? There is an ETF, and it goes by the ticker symbol OOO. I'll jump into Selfwealth really quickly. You can all just try and guess my login. Got to put for my password, I've got to do my thumbprint nowadays. The OOO ETF from BetaShares is the crude oil ETF. I don't invest in it, and I don't use any. This is called a synthetic ETF, by the way, William. I don't use any of these in my portfolio. So just want to make that full disclosure. But this is one of those that you can refer to. So yeah, and Jason said oil isn't a fantastic one in my opinion. Yeah, and I would agree with that, Jason. Okay, so this is the one that gets a few hairs on the back of a neck, and people get a bit feisty about this one. So this is a study, and it was originally done by an Arizona State University professor, Professor Bessenbinder. And what he found, studying markets all around the world, is that if you are picking individual stocks or you're picking individual whatevers, it is about 1 in 25 at best that those stocks that you pick do better than bonds. 1 in 25. So 1 in 25, if my math hasn't mistaken me, that's about 4%. Or I think this chart shows about 1 in 72 in the worst case. So meaning, this is where that old saying of a needle in a haystack comes from. And what it basically means is that if you are a long-term investor, you have to be extremely picky. You have to be extremely choosy because most stocks don't add a lot of value. In fact, around 60%, I think it's around 60% of stocks don't actually add any value. They destroy value. And that's quite remarkable. And so what it actually means is that on the stock market, you have this gigantic kind of like you have this, I'll just draw over the top of this thing, but you kind of have this big like skew like this, and it's only this last little patch of stocks in here that actually add any value. The rest detract value. And it's quite remarkable when you think about that, because then why does the stock market go up? Because those stocks on the right hand side are so good that they outweigh a lot of the other things. And that's these stocks up here. So I've actually got a report coming out soon on how to, like the key lessons from studies like this and how to identify them. But that's why these stocks account for so much of the value that's created in the world. Like, let's be honest, most of us use Apple for almost everything to do with computing, right? Or Microsoft, you know, that's just the reality. We do. And so they've taken share and they've created more value for society as they've got bigger. So it's kind of like inertia, it just keeps pushing them forward. But what it means for stock pickers is not just to be picky, but it also means this, that when you find a good investment, be extremely slow to sell it. I mean, the old cliche of buy low, like I can't believe that we actually use this as a saying in our industry. Buy low, sell high. That is just crazy to me. Because if you find one of these companies like right here or here, why would you try and buy it low and then sell it again to then go and try and find another one? That's just crazy. So some people say to me, well, Owen, you've owned Pro Medicus since 2017. Surely it's overvalued. Or you've owned Zero for so many years. Surely it's overvalued. But then I say to myself, yeah, but the reason I haven't sold it is because it's the single best company in the country. Not to put too much sauce on it, but that's the truth. It's the single best company. So no wonder I haven't sold it. It might not be undervalued today, but the chances of me finding that 1 in 2,400 again is going to be pretty hard. So I'm quite happy to let my money compound and not pay the tax. Water your flowers and remove the weeds, says CP. That's a great saying. It's just that you need to know when to remove the weeds. So Colin Davis, you said, can you name the study again? Yeah, sure. So the study is the Boston Consulting Group's 25, it's right here. What am I saying? I've got it right in front of me. Here you go. I'll put it in the chat. So for anyone that's watching this, including Colin, there you go. It's in the chat. So the value creators rankings. That's not the only study, but we're doing one at the moment at Rask, which will be published in the next few weeks. And it talks about this study, but it also talks about 3 or 4 others, including companies that make acquisitions to grow and why sometimes they're really, really, really bad when they do acquisitions. And sometimes, very occasionally, they can be good. What was number 6, says Caroline? Number 6 was just to be smart about how you diversify your portfolio. Like a lot of people in this case would have 4 ETFs that do the same thing or very close to doing the same thing. And that's okay from time to time. But then a lot of people just have 4 banks or all Aussie stocks and think that they're diversified. It's not the way it works. Okay. let's move through this. We're almost getting through it. So the next few are pretty philosophical, but just bear with me for while we get through this. So previously, as in the last 30 or 40 years, there's believed to be 3 common edges in investing. So let's say you've got the stock market index, but you want to do better than the stock market index. Well, in times gone by, people believe that there were 3 ways you could be better than average. One is you could try and master your behavior. Number 2 is you could have better analytics. Like when Warren Buffett started investing, he had to order the annual reports to be delivered to him. And then he would have to calculate all the ratios himself. And then he would make a decision by calling up his broker or going down. So, in fact, that's not even, you don't have to be as old as Warren Buffett to remember that. So, that is like this ability to use maths and analytics to your advantage. The final one is people believe that having access to better information. So this might be people like there are certain companies I can tell you right now that the ASX building in Sydney, there are certain companies that set up their companies next door to the ASX building just so they can connect to the stock exchange faster. That's called high frequency trading. And that's because they're trying to act on information before others do. It's quite crazy, but they do this around the world. Some stock exchanges around the world, effectively, when they have a high frequency trading signal come in, they block it and they slow it down to a normal signal so that when it gets to the stock exchange, it's the same speed coming in or out. It doesn't matter which way you enter the stock exchange. But I don't know if the ASX has put that in place in Australia. I don't know. I think high frequency trading could actually, I don't know, but it could actually happen. So, anyway, so my point with this is if you think that you have an ability to out trade or out analyze someone, that's fine. I probably don't feel like I do. I feel like I have a pretty good ability to analyze companies. That's why I teach value investing, but I don't think I don't think I have the ability to go against a computer, for example. And in terms of information, there used to be something called the Herald effect. Some of you will remember this one. The Herald effect is this idea that by the time it reaches the Herald Sun or the Herald paper, it's too late. The insiders already figured it out. And I remember Charlie Aitken talking to me about this. But today it doesn't really exist because, as I think it was Jason said, insider trading, he says, meet the CEOs and get them to call you with all their plans before they announce to the ASX. That's your edge. Yeah, so it's actually illegal to get insider info. Well, it's not illegal to get inside information. This is an important distinction. It's illegal to act on it. So it's illegal to act on that information. That's important to understand. But in any case, you shouldn't act on it if you get it. So there are rules that mean everyone has to have equal access to information. So that's not really an advantage as much. It might be a soft advantage, like you might be able to go down to the store and experience the company's products, which then gives you a better idea of the analytics. But I think for most investors, at least ETF investors, the best thing to do is to focus on your behavior. And that's what Tom Wickenden spoke about a few weeks ago on the show, is to focus on your behavior. I'll give you a quick example. This image was made by an AI. I said to it, dear AI, no, I didn't. I wasn't so polite. I said, can you please make me an image of Warren Buffett running away from a snowball? And this is what it come up with. Now, there are some quite interesting things going on. If you actually look a bit closer, there are some interesting faces on these notes down here. But anyway, my point was with this image is to show you that this image was created in seconds by this AI. And so this is where the future is. Like, this is where we're going into the future. It's going towards machines doing jobs better for us, even if those jobs are pattern recognition and that type of stuff. So this type of thing is going to become harder. And I saw in the AFR today that someone used a AI to try and pick stocks, and it did do a little bit better, but it was just quite funny more than anything. Paul, so Paul, I can see a question from you here. It has some interesting side effects from what I was reading. I think you're talking about AI. Yeah, there might be some. Okay, so let's go. We've got 2 more points. So the 3 ingredients, I think, having interviewed billionaires, professional investors, some of Australia's best CEOs ever, spoken with thousands of private investors just like us, studied this for years, read books, you name it. After all of that, I've realized that there are probably 3 ingredients everyone needs if they want to be an individual stock picker and they want to go and buy individual businesses. The first is you need to think, do I have enough time to actually do the research? Because it's very difficult to outsource your conviction. So what I mean by that is it's very hard to take a tip from someone else and to take that for yourself without doing any research. Like when we give research to people, we don't say it's a recommendation. We give them the research and we say, if you want to do the research now, or if you want a better understanding of the company, go and do that before you buy. And so you can't really outsource conviction. And the reason why is because you heard before, even the world's best companies, right, can fall 70%. And when they fall 70%, if you don't know why you're invested, you won't be able to hold on. So you got to make sure you have the time to invest. The second thing is a lot of people who invest in individual stocks like me, I've actually do it because I enjoy it. I actually just love learning about businesses, whether they're private businesses like a bakery, whether it's a public business. Anyone who knows me knows that. And so when I try and hire people or I see investors who I think will go on to do great things, I make sure that they're having fun. Because if they're having fun doing this thing, I think that is the number one ingredient. If you enjoy learning about the world and what goes into making a great business and making money, it's for you. Investing is for you. Now, if you don't like that as much, or you've just got a passing interest, that's great too, because an ETF or an index fund or a fund manager can take care of it, or a financial advisor. Finally, the number one thing that's left is curiosity. Curtis Larson, who is the man behind this, Curtis Larson is like a super, super bright investor from Australia. Not many people know about him. I think the only interview he's ever done was with me. I could be wrong about that, but I think the only interviews he's ever done, Curtis done, was with me. It was a very rainy day in Mossman, Sydney. But he said to me, these are the 3 ingredients you need. And curiosity is one of those, because when you fall over and when you hurt yourself in investing, it's curiosity about why things went wrong that will help you get back on the horse and do better. And so I learn from my mistakes just as much as I learn from success. There's a good question in here. CP, you've said, hypothetically, if the rest of your stocks in your portfolio do nothing, but Pro Medicus continues to grow and becomes 90%, would you trim it down and diversify into other stocks? I've sold it once before, CP, and the answer is probably no. And that's not what I should be saying on a live stream to hundreds of people. But the reality is, what works for me is completely different to what works for other people. Now, there actually may be a reason that I may be forced to sell Pro Medicus in coming weeks, CP, because I may need to take that money out and reinvest it into something else, which is I can't tell you right now about, unfortunately, but some of our members know what I'm talking about. So I may need to take my shares off the table to reinvest. And if I do that, I'll tell you all here before I do that. Yeah. So nothing is personal advice. You did see that. Did you guys see that little ticker tape? Thanks for the reminder, Rob. Did you see this little thing that came across the bottom of your screen here? How's this for a little thing? Look at that. Rask Live contains general financial advice only. Look at those little banners. It says little subliminal messages we just feed you here on Rask Live. It's really important to remember. I don't know your personal circumstances, as always. Okay, so high risk tolerance, which is why I only invest in ETFs. I have the latter, but lack the. I just read your comment, Owen. I won't respond to that too loudly. Okay, so super professional, says Financial Freedom. Thank you. Okay, so number 10. This is the lucky number 10. Is beware false choices. A lot of investors, when they come to investing, they get told that they have to invest in index funds, they have to invest in ETFs, or they have to do something. And then there's other people that say you should only invest in active funds. I remember hearing, how many times have I heard this on stage, that index funds are like investing through the rear vision mirror. Active funds management, where a stock picker picks individual stocks, is looking forward. I don't think you have to do any of those things. You can do both. I mean, like, you don't have to pick. Sorry, that's what we call a false choice, and we have plenty of false choices in life. It's like those people that go on extreme diets. It's no carbs or it's lots of carbs. It's no meat or it's heaps of meat. At the end of the day, it doesn't really matter. You should have a balanced diet and you should have a balanced portfolio. It's really that simple. And so I use both. I use majority ETFs in our core portfolio. That's probably something that I should have said before to that comment from CP. I use ETFs in my core portfolio. It's like almost exclusively ETFs. And when I say ETFs, I also mean active ETFs. Like many of you know this, but one of the ETFs that I quite like is the Femex ETF. Now, I shouldn't call it an ETF. I know that. This thing right here, this is actually an actively managed fund that looks like an ETF and it behaves like an ETF in the way that it's like purchased. Like you can just buy it through your Selfwealth account or wherever you do your trading. And that's an active fund that I would put in my core portfolio. And the same, like I've got VAS, right, in the core portfolio. It doesn't matter. And I've got individual stocks that sit around the outside, like my Pro Medicus and Zero and all that. And in there, I take a lot more risk than I do in the core. But let's just have a quick recap as we put a ribbon on this. I thought I'd get through in half an hour. That was ambitious. Okay, so almost all the time, there is something to be worried about. There's an old saying in the stock market that the market climbs a wall of worry. And that's relevant because over this period, I'll put here, since 1983, this is the entire US stock market. We've had multiple wars, we've had recessions, we've had super high interest rates, super high inflation, super low inflation, super low interest rates, super low government debt, super high government debt, the rise and fall and petering out of Bitcoin and all these types of things. We've had President Donald Trump in the US White House. We've had terrible things happen in other parts of the world. We've had Brexit. We've had, you name it, it's been in there. And at the end of the day, the stock market has still gone up. And you could argue that there are reasons why the stock market has gone up, like interest rates and that. But as we know, because I've covered it here multiple times on the show, on average, the stocks in the entire stock market increase their profits around 6 to 7% a year. So what you're basically betting on when you invest for the long term is capitalism. Second of all, in the short term, the stock market is quite random. And by that, I mean from 0 to 12 months. In fact, from 0 to 3 years, a lot of studies show that it's actually not the performance of the company that produces the stock market return. It's actually how other investors feel about it, otherwise known as the sentiment. So what you've got to do is just remember that there's a difference between short-term trading and long-term investing. The simplest thing in personal finance, I remember when I studied financial planning, when I did my master's of financial planning, I remember coming away thinking, well, if everyone just does the sensible thing and avoids like high debt and these types of things, it's actually pretty easy to, retire wealthy. And I know it's maybe it's simple, but it's not easy. It's a grind, but you can do it. It just takes time. Fewer decisions equal better decisions. Please don't rush into investing. One of the things we always say when we speak to new investors at Rask, and we've got thousands of them, tens of thousands of them, is to start really small because it's going to take your time. It's like an apprenticeship. You've got to learn on the job. But typically, once you know what you're doing, you make fewer decisions and you make them stick. Diversification is important, but you can never get rid of all risk. Diversification is easier than ever with ETFs and index funds and these types of things, but it does not get rid of all risk. There's always some risk in investing. That's what we call market risk. So there will always be some risk. But as Warren Buffett said, and I shouldn't have quoted him because now I'll probably have to take a shot or do something silly. He said that in the short term, stocks are risky. In the long term, they're risky not to own. And I think it's so true because over the long term, they have outperformed everything else. This originally showed a basket with different bank shares in it. You have to be mindful of how you diversify. If all you do is just keep all of your portfolio in bank shares, you're exposed to the same individual risk. The only reason this curve, goes down is because you're not correlated, as Will and Gabba said. So most stocks do badly is a fair comment. Most of the stocks on the stock market will not prove to be big winners. So when you do find them, pay attention, figure out why they're doing so well, and try and get more of that. And don't be scared if a business isn't growing the way you thought it was. Notice how I said business, not a stock price. If a business isn't growing, be prepared to sell it. I think most investors should focus their attention on behaving better when it comes to money. Of course, you need to do some analytics, like you need to actually understand what the business does, what it sells. If you're buying individual shares, or if it's an ETF, you have to know what's inside it. Um, the idea of having better information is probably not that relevant anymore, unless, for example, you're going down to Lavisa or JB Hi-Fi, or you're shopping at Costco or Walmart or Amazon or wherever, and you're seeing the businesses and you get a better appreciation of the human element of why they're doing better. That's probably better information, but it's not necessarily access. Number 9 is that I'd say most people shouldn't buy individual shares if they don't have the time, inclination, or curiosity to do it. It's not a hard and fast rule. You can still do it, of course. But I think those are the ingredients. If you want to be really good at it, those are the 3 things you need. Of course, you can get a subscription. You can get a subscription to like the Motley Fool or Intelligent Investor or insert whatever, Morningstar, Rask, whatever. You can get a subscription, and you can get research from really good analysts, and that definitely helps with the time element, and it allows you to scratch your curiosity itch. And finally, beware false choices. We give ourselves so many choices in life. You don't have to pick between active and passive. Use the best of both. I use an active fund manager in emerging markets, but I have a passive for Aussie blue chips. That's how I do it. Okay, so final thing for me, we've got a couple more minutes left, but will we see you on the road? If you haven't already, come along to a Rask Roadshow. We've got a lot better since we've started doing these. We've gone on a 10-part roadshow around the country. If you haven't already come along to one, please come along. They're heaps of fun. They're a great night. We've got a few left. There's 2 dinners left, one in Wangaratta and one in Port Macquarie. You can find the deets on the website. I'm also running a value investor program in Sydney in person for 15 people. I haven't done one for 3 years just because I've been so busy, but I'm hoping to get one full day intensive done. So if you're interested, come along. That's about it. I've got my quote for this evening though. The chains of habit are too light to be felt until they're too heavy to be broken. This is a really important thing because I want you to come back to Rask Live each and every Wednesday. It's a really good habit to get into because you'll learn so much about investing. But seriously, that's not what it is. I just think this is such a good reminder for when interest rates are high. A lot of people like myself have really high mortgage repayments. I can't invest as much every month. Maybe I'm not investing at all, but maybe there's a way for you to keep the habit. And any good coach or psychologist will tell you that it's easier to stack a habit on top of another habit, like rather than form a new one, because it's so hard to form a good habit like exercise. But it's easy to form a good habit like stretching when you're already doing one of the other things like running. And so even if you're not investing as much money right now, now is a great time to keep learning about investing and to keep that habit alive. And that's what we've been saying, everyone. Even if you can't invest thousands of dollars a month, maybe you can invest a couple $100, or maybe you can invest $10. Chatting to some guys on the road, a lot of parents and grandparents that I've been speaking to are saying that they just invest some money. And I won't give names away, but one of them, who may be here tonight, was telling me that he invests for his kids based on their ages. So if they're 11 and 12, he'll invest $11 a week and $12 a week into their account for them. And over the last few years, that's added up to a few $1,000s. So I was stoked to hear about that. I think that's such a great habit to form, and it's a great way to teach kids if you show them the account and what they're invested in. My little sister, actually, she did have a deadline. I know many of you know that I like to play a few games on my younger sister when it comes to investing. I've actually set her up an account, and if you're watching, younger sister, you have until the end of this week to pick your ETF, because it's the deadline is approaching. Or like doing push-ups during Selfwealth Live, says Rob. So probably got time for 2 more questions, guys. If you want to get some questions in, please go right ahead. Let me know. Ryan, you've said, just finishing high school, thinking about doing a commerce degree, ultimately trying to be a portfolio manager. Do you think people in the industry will have trouble finding jobs? Ryan, the answer is yes. I'm sorry to say this, but it's very hard to get a job in the funds management industry, especially right now, because what we're seeing, Ryan, is we're seeing more money flowing into index funds and away from active fund managers who typically pay the big salaries to individual stock pickers. And so, what that's going to have the effect of doing is to slowly take money away from those funds that would pay for stock pickers. But that I don't want to put you off this industry because I actually think it's a great industry, and I want to show you something. If I was what absolutely wanted to be an individual investor right now, what I would be doing is I would be learning things like accounting, and I would be studying these types of things because I think there are opportunities outside of just what we know as stock pickers today. This chart here was from a podcast that was shared with me, and this chart here shows private markets. So a lot of what we talk about when we're doing investing is we talk about what we can buy and sell inside Selfwealth. Like we can buy an ETF, we can buy an individual share, or something like that. I think I need to log back in again. We can buy Apple, we can buy Google, we can buy Telstra, whatever. That's called public markets. But in the private markets, these are like individual companies you might see down the road, or big industrial companies that aren't on the stock exchange, venture capital, these types of businesses. We're seeing an explosion on this side of the fence because on this side of the fence, you can't use ETFs and you can't use index funds to get them. The way to invest in this is through managed funds. And so there's still a huge demand for people that are really skilled in this part of the market. And this is a hugely growing industry. So that's where I'd be focusing my attention. Okay, so Paul, you've said my missus knows where I'll be at 6 p.m. every Wednesday. Well, Paul, don't forget next week when we've got the top 5 ETFs. So if you're interested in a bit of a juicy one next Wednesday, I'll be recording this from New South Wales somewhere. That's at 12 p.m. Same place, 12 p.m. And this is same place, 12 noon, get there. And then this one goes back to 6. So, Paul, maybe you can do it on work time instead of cutting into family time or time with a partner. And yes, there is good question, financial freedom. One of the challenges that we have is because this is streaming everywhere, there is questions in different channels at the moment. So hopefully over time, everyone gets familiar with that. But the problem that we have right now is it's streaming everywhere. So if you're watching this in Selfwealth, you might not see all the comments that are coming through Rask or the comments that are coming through ASA or the comments that are coming through LinkedIn. And I apologize about that. It's just going everywhere right now. So maybe we'll do something about that in time. That's why I repeat the questions every time, by the way. So, okay. Can't make noon, says Paul. Paul, it'll be available on replay. I do apologize about that. Okay. Ali, I'll answer your question. Here we go. Great one. Hi, Owen. I don't really spend too much time to analyze individual stocks, but I like to know what I own. So I don't like ETFs for that reason. I stay within the large caps in Australia/US and Hong Kong. Am I doing it wrong? Ali, I can't tell you what to do, Ali. I can't give you personalized advice. But generally speaking, what I can say is that everyone is different. And I think one of the best things any investor could do is know what they own and know why they own it. And whether that's an ETF or whether it's an individual stock or whether it's a property or a custom car, I think knowing what you own is one of the most powerful things you can do as an investor because it gives you confidence when things go wrong. As I mentioned before, one of the most successful companies in the world, everyone's like, well, Apple, I'll just buy Apple. Well, 25 years ago, when Apple was being bailed out by Microsoft for antitrust reasons, as in Microsoft wasn't doing it because they felt like they were good people. They did it because they could stay in business. When Microsoft bailed out Apple, Apple looked like it was going to go bust. And subsequently, as I said before, it fell 70% 3 times. So what that means is that when you experience one of those big falls, if you know what you're invested in and why, you'll feel much better about yourself and you'll have a lower chance, I would say, of making mistakes that you might regret. Now, of course, sometimes it's good to make decisions under duress, but sometimes it's not. And so that's why I say it doesn't really matter. Like a lot of the way I invest is very different to the way everyone else invests and vice versa. But that's why we're here on the night. We talk about all different types of investing. So I can see so many. Caroline says, I'll bring the cocktails and to Paul and financial freedom. So you will be able to watch next week's show on replay. You will get an email, whether you get the email from Selfwealth, ASA, or Rask. It all points to the same stream. So we all got the same stream. You probably even watch. Some people are probably watching this on Twitter right now, which is fantastic. Hello to people on Twitter. But I'm Owen Rask. You can find out more about Rask on any of our websites. You can get a ticket to our event by Googling Rask Roadshow. We've got the Value Investor Program live in Sydney as well next month, so check that out. Don't forget Kate's book, Buying Happiness, out this week. I'm so proud of her and so happy for her. So she's achieved so much. So, CP, you've said, I'll answer this last one. List of investors you follow who are not known widely. I'll give you some real quick names, CP. I'll even show my screen. Some names that you should follow. Norse Capital, DMX Asset Management. These are all small cap funds. So these are all small cap investors, DMX Asset Management. And Merriweather Capital. This is Luke Winchester. I don't know if he does as much anymore, to be honest. I don't think he does it anymore, but Luke Trickett, Libby Trickett, if you know the swimmer, his partner, or her partner. These are all people that I used to read religiously and still do to some respects. I don't think Blue Stamp has published much lately, but those are some of them. Tom, you've said, when do we find out who won the ETF contest? That's a good one, Tom. If you're in the Selfwealth and Beta Shares community, you will find out soon. Obviously, if you win, you find out. But the competition has closed, I believe, now. So don't forget to subscribe to the show. We'll be back next Wednesday. It's a full back catalogue for everyone on Selfwealth. Go and check that out, Selfwealth Live. I'm Owen Rask. I'll see you soon. Jason, might see you in Newey. See you in Newcastle. Let's get there. That'll be a great night, mate. So I hope to see you then. Thank you, everyone. And bye for now for the first Rask Live. I'm so excited about what comes next. Thank you so much. And I know how much you love disclaimers, so I'm going to leave you with the disclaimer on the way out. Bye for now on behalf of Rob and I. Thank you so much for tonight and see you next week.